okay, the prices have run up, but the earnings have not caught up. So does that mean that we're in for a time correction?
We are seeing a time correction, if you ask me. And while the headline Nifty does not show any major correction, but across the board, small mid-cap companies have seen 15-20% type of correction. A lot of the PSU stocks, which were highly favored, are off the highs by 15-20%, 30% or so. And many stocks, I feel, after the December quarter numbers have seen a reasonable correction, but I think more needs to be done for them to come in that perfect zone. By perfect zone, we mean that the price earnings to growth has to be between that 2 or 3 times. That also I'm stretching it.
So where is it that the PEG is looking good, where there's still opportunity in this market?
Oh, I'm just scratching my head so far to find those stocks and looking for suggestions, frankly. But right now, there's very little space in the market, or very little, I would say, counters which have got that perfect value where investors can certainly invest and make some money. So, which is why my view on the market has been.
Hey guys, welcome to the 45th episode of our series. We're here to talk about a really emerging topic in the market. There's been a lot of news flow around overvaluations of small and mid-cap stocks. And as a result, SEBI has put out a circular and AMFI has also put out guidance circulars requiring mid-cap and small-cap funds to restrict inflows and restrict outflows from their funds. At the same time, SEBI is talking about oversubscriptions on IPOs and a lot of IPO listers being listed at valuations that are far too high. And so we're here with Mr. Deepan Mehta, a returning guest, to talk about this subject and generally just lay out what this landscape looks like. So I wanted to maybe set the context, because overvaluation or undervaluation is typically measured by two ratios: your PE ratio or PEG ratio, which is derived from the PE ratio. So I'll try and explain the PE ratio, and maybe you can just break out for us what that really means.
Sure, it's a good way to start.
At a very technical level, the PE ratio is the price to earnings, which is the price of a single stock divided by the earnings per share. Broadly, it tells you that in how much time,
how many years
will the earnings that this stock is accumulating for you justify the price you've paid for it?
That's right. So just to take off from there, it's basically how many years the earnings will be required to reach the level of the stock price. So for PE multiple is 50, then it will take 50 years for the company at that rate of net profit to aggregate it to reach the share price. That's how the PE multiple is calculated.
And the obvious, the obvious missing piece in this equation is the growth of the earnings, and which is where you get PEG, which is price divided by earnings growth. So can you talk us through how that's calculated and what that means?
That's right. So price earnings growth, PEG, is also a very important ratio. And basically it is the price to earnings multiple divided by the sustainable long-term growth of the stock. So if the PE multiple is 50 and the stock can grow at, the earnings can grow at 25%, then the price earnings growth is 2 times. That's a simple formula. But Varun, the price to earnings multiple is one of the most, I would say, very difficult to understand and set a price to earnings multiple, because each one has a different view on the stock, and that view is reflected in the price to earnings multiple.
Right.
So it's not just a simple calculation of price divided by earnings per share, but what goes into the PE multiple is many components, like growth in earnings, the floating stock, interest rates,
right,
how much fancy or who owns the stock sometimes also makes a difference.
Right.
So there are many components, and it is not that we can paint all stocks with a single brush and say that, look, this should be what the price to earnings multiple is, and because of that, the stock is cheap or expensive.
Right.
A 100p stock may be cheap, and a 10p stock also may be expensive.
Right. No, that makes a lot of sense. But let's set the context by talking about what the PE looks like at an aggregate for the Nifty.
Yes.
And, particularly let's look at where the mid caps and small cap index is, because I think that's a really good base to set for our viewers to understand why we're talking about this subject.
That's right.
So if we go from 2019 till 2023, in 2019, the Nifty had a PE ratio of 28.5, and today we're sitting at 23.3. In 2019, the mid-cap 50 had a PE ratio of 23.4. Today we're sitting at 21.4. The small-cap PE was 49.5, and today we're sitting at 27. But it's important to note that in 2022, the small-cap PE was 18.6. So while the large caps, which is the Nifty 50 and the mid caps, have largely come down to this PE ratio, which is where we're at. The small caps came all the way down to 18.6, but in the last year have run up a lot.
That's right, because we all know the froth which is there in the small mid-cap stocks. And clearly over there, I feel that prices have run ahead of the potential of the company.
Right.
And I think these are aggregate numbers, Varun. But as an investor, when you go down the line into the companies you want to buy, especially the ones which have got good growth prospects or excellent business models or very aggressive managements which can really grow the business. So you want to be, when you look at the P multiple of the truly investment grade stocks, that is very high.
Right. Could you highlight that with some more information? Because at the surface, it doesn't seem that way. So what are the stocks that you'd specifically point to as having a very aggressive multiple, so to speak?
So the one which has got the most aggressive multiple, which people keep talking all about, and the stock price keeps going up, is Trent.
Right.
Can you believe it that Trent goes at a price to earnings multiple? And mind you, we are talking about P multiples on a trailing 12-month basis. We are not looking at the future. As a conservative investor, I like to work with the price to earnings multiple based on the trailing 12-month earnings per share. So Trent is going at 160 times. Now, can you imagine 160 times is Trent going to take, means you have to be invested for 160 years and have the same, if the earnings grow at the same, if the earnings remains constant, then in 166 years, it will equal to the share price. Of course, the earnings will keep on growing. But look, 166 times is just way too high. And Trent has been trading at rich P multiples all across its history for the last 15, 20 years or so. But 166 is at an absolute peak.
Right. But it's not just Trent. I know there's a whole list of companies underneath. I think the Adani companies quite famously all trade at very expensive ratios. Geo Financial company that has no operating profits is trading at an infinite PE. But there's a small set of companies, or at least what it seems like is there's a small set of companies that are trading at these extremely high valuations, but the vast majority of companies don't seem to be doing so, or is my understanding of the situation incorrect?
No, I think in my opinion, the entire P multiple of the market has gone up. I would suspect 50-60% higher than it was 3-4 years ago, or what it was before the pandemic hit us.
Right.
No
But
doubt earnings also.
the numbers clearly suggest otherwise. Like this is, we're fairly confident that at a headline figure, the P is low. So why is this the case? What's driving this?
So as I said, I think there are a lot of companies over here which may be quoting at reasonable P multiples, but they were much cheaper much earlier, and then their profits also have gone up. But those are not really the type of companies which can deliver spectacular returns or multi-bagger stocks. But the whole host of stocks, like we talk about Titan or Trent we spoke about, and there are similar companies down the line in the retail like Avenue Supermarket. These companies really have the potential to grow over 15-20 years also because of the way the consumption patterns are changing. And these stocks are trading at very rich multiples. And you compare them to what they were 1 year ago, 2 years ago, I think the P multiples have gone up by 30-40% or so.
Okay.
And the growth rates of these companies have come off.
Okay.
That's a very important point, Varun, that I don't mind the high P multiple, but if the growth rates are going to start to slow down, like Avenue Supermarket, which used to grow at 50-60% 3-4 years ago, now growth is barely 15%, 17% or so. But the P multiple still remains above 100 times.
Right.
So in the context of the growth reported in the last 2-3 quarters, price to earnings multiples are on higher side.
Okay. So what you're saying to me is that it's okay, the prices have run up, but the earnings have not caught up. So does that mean that we're in for a time correction?
We are seeing a time correction if you ask me. And while the headline Nifty does not show any major correction, but across the board, small mid-cap companies have seen 15-20% type of correction. A lot of the PSU stocks which were highly favored are off the highs by 15-20%, 30% or so. And many stocks I feel after the December quarter numbers have seen a reasonable correction, but I think more needs to be done for them to come in that perfect zone. By perfect zone, we mean that the price earnings to growth has to be between that 2 or 3 times. That also I'm stretching it.
Right.
Ideally, when I've bought stocks back 15-20 years ago or so, I've bought them at PEG multiples, price earnings to multiple of less than 2 times. I don't think I'll get into that situation ever, but I think still 2.5, 3 times is still reasonable.
So I just want to try and talk about that PEG ratio again a little bit more, because the PEG for the Nifty 50 as an example is 1.16. So it seems like even from a PEG perspective, we're quite far away from your threshold of overvaluation.
So that because they just look at the last 2-3 years earnings, which have gone up because of the base effect. But from this point on, to expect the Nifty to sustain the same kind of growth rates, I'm not so sure.
I
Because the
see.
Nifty, the larger companies are the banks, they're the software companies. Like let's just take the software companies, Varun. A large part of the Nifty, I think 80-90% comes from software companies like Infosys, TCS, Wipro, so on and so
Sure.
forth. The earnings are flat.
Yeah.
But their P multiples are 25 times to 30 times or so. So while their PEG may be on the lower side because historically their earnings growth have been 15-16% or so, but from this point on, 1 year, 2 years down the line, it
The
looks a
PEG
bit
doesn't look
challenging.
so great. Okay,
So,
I see your point. So where is it that the PEG is looking good? Where there's still opportunity in this market?
oh, I'm just scratching my head so far to find those stocks and looking for suggestions, frankly. But right now, there's very little space in the market, or very little, I would say, counters which have got that perfect value where investors can certainly invest and make some money. So, which is why my view on the market has been a bit cautious. Having said that, I mean, I should answer your question. Having said that, the valuations are reasonable in the banking stocks, banks and BFCs, right? And so it's not just the P multiple of these banks and NBFCs which is low, but even the price in the PBG, it means price to book value also. That also is in a way quite reasonable for the banking sector as a whole. But banking sector and banking stocks are plagued by other issues like over ownership. Everybody owns bank stocks like HDFC, ICICI. So there's only so much that you can own. That is point number one. Point number two, last quarter numbers show that their net interest margin, which is the difference between what they borrow and what they lend at, that's gradually compressing because liquidity is tight.
Right.
Liquidity is tight because RBI is wanting to prevent inflation from going up. So that's one sector where the price to earnings multiple are still reasonable compared to historic levels, and long-term trajectory of earnings for these companies is still sustainable in that 15 to 17% type of range.
I see. I see your point. I want to try and challenge this maybe long-term earning growth trajectory because something interesting I came across recently is that the vast majority of loan growth is coming from new loans to existing customers, and it seems like the total population in the country that you can give a loan to of 250 million or so has pretty much been saturated. And so we'll try and put some numbers up to bring this to light. But from that perspective, do you still think 17, 18% kind of growth for these banks and NBFCs is possible without diluting credit quality?
See, on part of the credit growth depends upon the growth in the nominal GDP. Now, we had 8.6% figure for December quarter. And if you add the inflation, then India's nominal GDP growth is easily 11-12% or so.
Right.
And normally, credit growth is 1.5 times or so. So that's a theoretical number for one. For two, we are seeing two very important, or I would say three very important trends for banking stocks. One is the capex cycle has looked up. Second, real estate is doing well, and third, auto is doing well. So these are three segments which consume a lot of debt and credit. Could be retail, could be wholesale as well. And Indians, unfortunately, are just discovering the magic of personal loans, unsecured loans. It's not a great trend, but it's a reality.
Right.
And a lot of the growth in the loan book of the banking and the NBFC sector is this slightly more risky loans. Credit card loans, you can add credit card loans to that.
So when we're talking about banks, you're saying, okay, liquidity is tight. And when you were talking about a PE multiples as well, you were saying that it's heavily influenced by interest rate. So I want to maybe talk about the interest rate for a second. Because certainly over 24 and at least first half 25, it's fair to expect interest rate cuts, certainly from the Fed, and if from the Fed, then likely from the RBI as well. They follow the Fed to some degree as well. So how do you think that might play out? Let's start with how that might play out for the banking sector. Will that give credit growth more of a boost? Will that boost the valuations? What does that look like?
Most important thing, the net interest margin. What I explained, what they borrow, and that will go up.
Okay.
Because banks will be very cagey to pass on the interest rate cut if at all. Secondly, Varun, I'm not so sure that we'll have very aggressive interest rate cuts unless the economy starts to slow down, whether in US or India, in a significant manner. The central bank is perfectly fine with keeping elevated interest rates. Because what they're doing is they're creating powder keg that in the event of there being a depression or a sudden depression, but in the event of there a recession coming, then they can quickly reduce the interest rates and lessen the pain.
Right.
So don't bank on sharp reduction in interest rates anywhere in the world.
That makes sense because they've spent 20 odd years through, I think, two major cycles printing a lot of money.
That's true.
So somehow they have to put that genie back in the bottle. And elevated interest rates is pretty much the only way to do that.
Absolutely.
So I guess let's move on. So another thing that I wanted to try and talk about is a lot of the companies in which we're seeing these highly saturated valuations, a lot of ownership, all play very heavily on the consumer theme. And I know that's a theme that you really enjoy investing in. That's what you really believe in for this country. But periodically, we also have the peaks of cycles where your cyclical stocks, where your commodity stocks, they do really well. So my question to you is, are we about to enter that cycle where, okay, the valuations for these consumer companies are so inflated, so money will start flowing into these relatively cheaply valued cyclical businesses, the kinds that you don't like the commodities, the cements, the PSUs. Is that what's going to play out in the next year and a half?
It's a very good question. I used to buy steel stocks when the book value of the steel stock was equal to or below the stock price. So we spoke about price to book value, right? Which is the stock price divided by book value. Today, steel stocks are trading at 2 times. And I don't think you can really make money buying steel stocks or any commodity stock at 2 times book like this. Cement stocks, where the underlying growth rate can be around 10-12% or so, they're going at price to earning multiple of anywhere from 28 to 50 times or so. And mind you, this is a sector where there's massive capacity expansion happening.
Yeah.
So the return ratios also will go down. One more important point about the P multiple is the return on capital employed.
Right.
We must mention that. Sorry, you forgot about that.
Let's take a second. Let's just talk about what that means as a concept, because it's one of the most fundamental concepts of investing. Would you like to outline it?
That's right. So return on capital employed basically is what you earn on the capital which you've employed. Return on capital employed, return on capital. There are various formulas you can look up on Google because it's a sort of complicated calculation. But the P multiple, when we mentioned interest rates, earnings growth, ownership pattern, floating stock, more importantly also return on capital employed. And generally companies which have a high return on capital employed, people pay a higher price to earnings multiple.
Right. So let me try and break it down on a conceptual level for the less financially advanced viewers. Return on capital employed is if I invest 100 rupees into a business, what return is that generating? So we talked about the nominal GDP growing at about 11-12%. You want a return on capital employed that's more than that 12% or so, because it means that your money is generating more cash flows than the nominal growth of the GDP. So just wanted to try and benchmark this as a concept. So let's come back to this conversation around cyclicals and commodity stocks.
That's it. So as I said, steel stocks are trading at historically high price to earnings multiple.
Price to book multiple.
Price to book and price to earnings as well.
Okay.
Compared to what they have traded at other cycles, especially when what they have traded at the peak cycle. And we are at a peak cycle just now. Cement stocks, as I said, are trading at price to earnings to growth of around about 2 times plus or so. And it's not a business which is really a wow business, which has got a lot of moat around it. It's a commodity business end of the day. Aluminium companies, copper companies, zinc companies, where there's high cyclicality because of international price movements, they're all trading at pretty rich P multiple. I used to buy these stocks at 7, 8, 4, 5 times or so. Now they're all double-digit price to earnings multiple. So from that point of view, even that sector is more expensive. But there are fund managers who believe that if they want to reduce the average P multiple of your portfolio, then you can add some commodity stocks, because clearly those are the low P multiple, even as of now on an absolute basis.
So I want to try and come back to this core number, right? The Nifty 50 is a P of 23.3. Now I'm saying our consumer stocks are overvalued and they're above 25. Like IT stocks, above 25, slightly overvalued. Consumer stocks, above 25, slightly overvalued. And I presume it's just the commodity stocks and the infra stocks that are bringing this average down.
That's right. So it's the power companies, the utility companies, which is bringing it down. It is some of the commodity companies which is bringing it down, the steel companies also, which is bringing it down. But this is also, I think, it's not trading 12 months. It is more, I think, for the current year what the earnings are expected to be. So, and I don't know how these calculations are done and all that. I, as an investor, when I look at company by company, sector by sector, and I compare to what I was buying 1, 2, 3, 5, 10 years ago, I feel it is expensive. So it's like a mental block for me.
I understand.
That something business which I know can grow at 15, 17%, I used to buy at a P multiple of 35, 40 times. How can I get myself to buy it at 55, 60 times or so?
I
That's
see.
where we are.
So what should investors do in this current state?
Well, I think the endeavor to find attractive valuation still remains, and from time to time we will have such stocks. Our Paisa Maker series, which we are doing, has got some of those stocks where we feel the valuations are still reasonable. And second, I think you wait for the P multiples to compress. And Varun, that can happen in two ways. The stock price can correct, or you wait for 2, 3 quarters and the earnings start to go up, and that's how the P multiple will compress. But I think that if you have a discipline around investing in a company at a reasonable valuation, at a reasonable price to earnings multiple, that's the secret sauce behind exceptional returns. The minute you let your guard down and buy even a good quality business but at an expensive valuation, you will find the returns are subpar. You may not lose capital, but your outperformance, the kind of zing which you want in your portfolio, that will not come. And that will start to show up 1 year, 2 year, 3 year down the line.
Okay, fantastic. I think on that note, let's leave our viewers with that really important statement. And thank you so much for joining us.
This podcast is produced by Elixir Equities Private Limited, a SEBI registered research analyst. Registration number INA00004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing.